Okay. Well, let's go ahead and jump right in. Oops. Oops. Okay, just to let you guys know, I put these ratios on are on the front of all of I think all of the Excel sheets from here on out. And the reason is because in different chapters they ask for different things, and it's just easier to have them all in one spot. So if they ever ask for a ratio, they're there. And if you're ever going through, and they're asking for ratios, they're all there. Okay. This accounts receivable aging 1. Okay. All right, aging accounts receivable. And what are we actually doing here? In chapter 1, we talk about accounts receivable that they're assets because we're going to collect it in cash, right? So if we sell something to someone on credit, well, eventually they're going to pay that off. So we sell something for $100, we have accounts receivable for $100. When they pay it off, then we get the cash from it. Well, obviously, especially if you have a lot of accounts receivable, you're going to have some that aren't going to be collected. It's just, kind of the way it goes. People go bankrupt, people leave the country, people die. There's all kinds of reasons why you may not collect all your accounts receivable. And notice though, it's sort of misleading if you put the total accounts receivable in the books because you're not going to collect all those. So if you say there's $1,000 of accounts receivable, but you're not going to collect all of it, you really, it's misleading to put $1,000 on the balance sheet, on the financial statements, because you're not going to collect all that. Okay, so what we have to, and now there's a problem, and the problem is, I look at these accounts receivable, let's say they're on the books for $1,000. I don't know which one's going to go bankrupt. I don't know which one's not going to be able to pay. I don't know who's going to die or whatever. So you can't just, and you don't have a crystal ball. You can't go into the future and say, oh, I know that this person's not going to be able to pay. So, the question is, what do you do? Well, you have to estimate. We don't have a crystal ball. So we can't go in the future and figure out who's not going to pay. And if we did, we probably wouldn't have sold them in the first place, right? I mean, if you had a crystal ball, knew who couldn't pay. But anyway, so what we're going to do is we're going to estimate. Okay. Now, this aging accounts receivable, this is a very common method. If you have basic QuickBooks software, it'll do it for you. But what it says, what the whole idea behind it is, the longer that something is overdue, the less likely you're going to collect it. Something that is 3 days past due, you're more likely to collect than something that is 3 months past due. Something that's 3 months past due is much more likely to be collected than something that's 3 years past due. So as time goes on, it becomes less and less likely you're going to collect it. And that's the whole idea behind this aging, that the longer it goes out, the less of it you're going to collect. And you have to write some of this off, write some off those accounts receivable. And again, this is completely an estimate. You might look at what you did last year to make an estimate, but it's an estimate. It isn't fact. It's an estimate, and it's not going to be perfect. It can't be, but it should be close, hopefully. Okay, so problem 1. Says current balance on the allowance will count as 0. We'll talk about that later. We don't need that for what we're going to do on this first one. But here's the uncollectible. So the account age, if it's 0 to 30 days, sometimes they'll call that current, that this is 0.5%, it will not be collected. And you'll notice as you get further out, you get to 90 days, 2.5%, 120 days, 4%. Over 120 days, 20% of them aren't going to be collected. So what we're going to do over here is estimate for each one. We're just going to multiply these out. Okay, so this is so I just multiplied each of these times the amount. And you can see, okay, so there's 40,000, there's gonna be 8,000 aren't collected because these are way far out. It's been 4 months or whatever. And then I'm gonna add all those up. Okay, so this is gonna be our bad debt expense. It's an estimate. I think they call it uncollectible accounts. These bad debt, I can't remember. I got that pulled up here. Let me see if I can. What they call it. They call it bad debt expense. Okay. Well, we will do the same then. Let me get that a little closer. Okay, so our bad debt expense is going to be that. Hey, it worked. This dumb look. Okay. The total balance in the accounts receivable will be over here. I'm just going to add all these up. Let's give that a color. Kind of bluish. Okay. And so this will be our total accounts receivable. That. And calculate the net realizable value. Okay, so here and here's the whole idea. We're not going to be able to collect all of this 1,365,000 of debt of accounts receivable, I should say. So how much are we going to get? Well, you know what? This is actually let me do something else. So we actually be what they call an allowance. This here. So there's that much in there. We're going to subtract it. I don't think it's a negative, actually. And so this will be our and they usually put this in like this. This will be accounts receivable. Net. That's usually the way you see that listed. I'm going to do a couple things here. I want to go into this bad debt expense and the allowance. They're actually two different things. I want to just talk about them briefly. And the allowance account, it could have something already in there. I'll show you what I mean here. Let's make that a different color. Oh, that looks too close to the other one. Let's try orange. Let's try oranger. Okay. So the allowance for bad debt started out at 0. We had this bad debt expense for this. And so the total amount we needed is this whole 25,000. So this would look like this. So these two are actually related. But there's going to be a little bit of calculation we're going to do on the next one. And this is really what we want that allowance for bad debt to be. We want it at the end, we want it to match up with this. And this happens to be the bad debt expense because it was started out at 0. So what these one are both the same. But we're really going to figure out that this is going to be, for most problems, this is going to be the allowance that we have. And then we'll figure out what the bad debt expense is. Okay, what I want to do though is one other thing. I want to jump to the homework problems and I just want to show you a little, I'm sure you guys already know this, but I'm going to jump into it again anyways. And that is, when you're doing these problems, a lot of times, to do this problem, you could pull out your calculator and you could pull out your calculator and add them up, and they don't really allow you to do that on the screen here. But you can just copy all these, and you should be able to do this. Test to make sure you can. And if you just paste it in here, the formatting might be a little wacky, but then you can just simply multiply them out. Now, you probably have different numbers than I have, but the idea is exactly the same. Just to speed things up. Hey, those are exactly what I had, isn't it? Hey, no, close. They're a little different. And they kind of, you guys probably figured it out already. They kind of jumbled the numbers around on these. No one has the same numbers for the most part. But anyway, you can just copy and paste it into Excel. It just speeds things up. Okay. Let's go back to Nope, not that one. Let's get rid of this. Okay. Let's go to the second problem. Very similar with a little bit of a twist. Which we'll talk about in a second. Okay, everything else is the same. We'll just multiply these out. Add them up. Now, this is actually what we want the allowance account to be. We actually want the allowance account to be 18,810. Okay, so coming over here to the side. We want the allowance account at the end. I'm going to give it extra space here. We want it to be this number, 18,810. Currently, it has $1,000 positive in it. So there's still $1,000 sitting in that account. So here's a question for you. How much do we have to expense to get this up to the 18,810? You know, what do we want to put in there?
$17,810.
Yep. Yeah, there's already 1,000 in there, so we only have to expense 17,810. We want this at the end to be worth this, right? This is what we really want it to be worth. And we want it to be worth that because that's our best estimate as far as what these aren't going to be collected for. Okay, so the allowance for collectible accounts will be that. But the bad debt expense is going to be less. It's going to, I didn't put it in.
Sorry, I have a quick question. Not to interrupt you. So is the only difference between this problem and the prior one just that they give us a starting number in the uncollectible accounts?
That's exactly right.
Okay, so when they do give us a value for the uncollectible accounts, then this is what we would do versus if they say it's 0.
Yeah, exactly. And let me see if I wonder if I probably have one of those in here. That's probably why I put that. Let's see if I'll see if this is one. Yeah, so this is, let's see. Yeah, this is a positive balance of, yeah, so this the problem 3 would be similar to this one. So problem 1 will be similar to the first one we did. This will be the first one. I don't know why I put them in that order, but number 3 will be similar to this one we're doing on the second page.
Okay.
So actually, let's say homework problem 2. Oops, no. It's homework problem 3. this one was homework problem 1. This one's similar to homework problem number 3. Oh, I didn't put it in it. Sorry, this is 17,810. So this is like problem number 3. And again, for this one, you can copy these and put it into an Excel sheet. This one you have to copy, it looks like in 2 different chunks. Like this. Yeah, copy. And again, it doesn't have to look pretty in here because it's, you're not going to turn this in anyway. So multiply them out. And again, you guys probably have different numbers in yours. They kind of scramble the numbers up, but yeah. Okay. Okay, so accounts receivable turnover. And this is like problem 2, I believe. Yeah. Okay, so receivable turnover, we have net sales over, and this is net accounts receivable. They've already taken out for the bad debt. The allowance for bad debt's already been subtracted. So this is what they think they're going to collect for the accounts receivable. These are the sales for the year. So they're saying, okay, how many times do we collect, these sales? 45,000 and say, oh, these are millions. So what is that? 45 billion? It's Coca-Cola. Yeah, I guess that makes sense. So anyway, we'll put in so in year 1, the turnover, it turned over 8.82 times. You generally like this to turn over a lot. It's usually quicker turnovers are better. And that's usually for most turnovers if you want it to be quicker. So in year 1, it was 8.2. Year 2, it went down, it decreased a little bit. Okay, now the question becomes, how many days do you have to wait to get your money? You're doing 5 days or 15 days or 30 days or whatever it is. So you take 365. Now, if you look down here, this is just the same thing we did up here. Net sales divided by accounts receivable. This is just the turnover. So we're going to use these same numbers here and here. Oops, no. So I'm just going to copy that there. So this would be the turnover for the year 1. And the days that it took to collect it be 41, a little more than 41. Year 2, it took 42 days, almost 43 days to collect it. And again, you want your money sooner. So the shorter the period, the better. Okay, how much is that in there? How much additional cash flow? It is in there, okay. How much additional cash flow could, size here a little bit. How much additional cash flow could Coca-Cola Enterprise generate in year 2 if it could reduce the receivable collection to just 30 days? Okay. Year 2, so let's look at year 2 here. 42.89. Okay, so what we're going to do is look at our accounts receivable for year 2. Now, how much are they collecting? How much is for each day here? If we go over here, it is 42. Wait a minute. What are we doing here? Yeah, this is right. Hey. Should have set this up a little bit closer. Okay, so 42.85. So this is how many days? It takes to collect that. So we're going to divide those. So 5,400 divided by 42.85 days equals some number. No, I should maybe do something here. Kind of show you how I got that. Just plopping the number in there. So this is the collected per day. Okay, so what are we going to do with that? There's a couple ways to do this, by the way. Any ideas? We know how much we're collecting per day. And they're saying, what if we could get it down to 30 days? Oops. What if we could get this down to 30 days? How much additional cash would we have from that? And And this is what we're collecting per day. Ideas?
Can we multiply the collected per day by 30 and then take the difference?
That's exactly right. Very good. Yeah, so say, okay, well, let's say that we get this down to 30 days, right? So let's say 30 days. We're going to multiply this. So this would be our accounts receivable for 30 days. So this here is accounts receivable for 42.85 days. Here. And this down here, this will be the accounts receivable for 30 days. Should probably make a little different color. Too dark. It's the hardest part about accounting. Well, let's make it green. Let's make it dark. Okay, so this is our accounts receivable for 30 days. So what we can just do is take the difference between those two. And so that would be the savings. What are they asking for? Additional cash flow. So our additional cash flow will be the difference between those two. So subtract them. And this is like problem 2. What did I do? And the whole point of this is that you want to get your money back faster. The faster you get your cash back, the better. You don't want to get it back so fast that you lose sales because of it, but again, you don't want to needlessly have it put off. And again, and the longer something is outstanding, the less likely it is to be collected. Okay, question on that thing? All right, sales terms. Now, this is something that is not in the homework, but it is on the test. So that's why this is here. The test, this is on the test. Okay, revenues are sales of goods, services to customers. Revenues are received only when they are earned, regardless when the cash is received. Payment received from customers are in advance or liability. Okay. Well, this is kind of an interesting one. If a customer pays you in advance, it's not a revenue, it's a liability. So revenues, when they're earned, we count them as revenues. Good, you know, it doesn't matter if we get the cash yet or not, we count it as a revenue when we earn it. And if you receive a payment ahead of time, it's called deferred revenue or unearned revenue. And it's a liability. And let me explain that a little bit more. So I'm gonna mow my neighbor's yard for $20. No, I mow the lawn, my neighbor gives me $20. I count that as revenue. Right? Okay, take another scenario. I mow my neighbor's yard. And neighbor says, look, I don't have the cash right now. Can I give it to you Monday? Sure. I still count it as revenue because I've already earned it. So it'll be a revenue and I'll have an accounts receivable for the $20. So even though I didn't get paid yet, I've done the work. I've earned the money. I'm going to count it as a revenue. Okay, so that's the kind of idea between accounts about accounts receivable. We still count it as a revenue. We still say, okay, this we did our part. We're done. You know, I'm done mowing the lawn. I mowed the guy's lawn. Okay, now let's take another situation. My neighbor says, oh, can you mow my lawn? Here's $20. I said, well, you know what? I can't mow it until next Thursday. That's fine. Gives me the money. I take the money. Now notice, if I don't mow the lawn, I have to give this money back. So that's why it's a liability. Now, once I mow the lawn, then I've earned it. I can keep it. But until that happens, it's a liability. So if you get paid ahead of time, it's not a revenue. You haven't done anything. It's not earned. Until I mowed my neighbor's yard, I haven't earned the $20. And again, if I don't mow it, I got to give my neighbor back the $20. So that's why if someone pays in advance, it's a liability. It's money. It's sort of like money owed. It's someone to a payable until you actually do whatever it is you're supposed to be doing to earn it. Okay, sales terms. Over the years, you know, they used to have these contracts that were really long and laborious and spelled out everything. Eventually, they got down to kind of condensed terms. And so it's very common to see things listed as something like 210 net 30. And the question is, what does 210 net 30 mean? Okay, the first one, the 210, means that you get an early discount of 2% if you pay it off in 10 days. Now, if you miss it, the 10 days, then they say, okay, well, everything is due in 30 days if you don't pay within the first 10. Make that blue. So net means no discount, but you have to pay it in 30 days. So 210, 2% discount if you pay it in 10 days, 0 if you pay it in 30. Okay, so here's an example. Customer's invoice. Oh, same thing here. It's just different terms, but they're, you know, same idea. This is 415. And again, you might say, well, why are they doing that? Well, they're doing that because they want to get their money faster. The faster you get your money, the better. And so that's why they're giving these terms that are actually fairly generous. And I don't think they go into that in the book, but I will maybe I'll talk a little bit about it. Okay, so let's say we have a customer's invoice. And 6/9, paid the invoice on 6/9/22. When is it for? Okay, so here's the invoice date. They paid it 9, so that's what, 8 days later. So they're within the discount period. So here's $1,000. 2%. So say equals 1,000 times 0.02. And I'm gonna put a negative in front of that because that's gonna reduce the amount that they have to pay. So the total payment from the customer will be this. Now, the customer pays on 2/29. Okay, that's 28 days out. So they missed the 10-day period. So this will be the same 1,000. Discount. There is no discount. And so they will have to pay the entire amount. So that's how this kind of works. So if it's 210 net 30, that's how the they pay it in 10 days, they get 2% discount. All right, now here's the thing that's a little bit, I don't want to go too far into this. But notice that the difference in payment here is 20 days. So while 2% doesn't seem very thrilling, you say, well, 2%, big deal, right? 2%, you know what, that's not very much. Well, it's 2% over 20 days. Let me read this over here. Okay. So you say, okay, well, that's not very much money. That's, who, you know, it wouldn't matter whether you missed that or not. Actually, how many 20-day periods go into a year? And I'm just gonna say that a year is 360 days, just to make it easy. Yeah, let's go 360. 360 to make it nice, easy numbers. Okay, so that means that if this is a period is 20 days. Days in a year, so this would be periods in a year. So 2%, and you multiply that times 2%. That's actually 36%. So a lot of times these the actual amount of a discount is way more than shown on there. And so important on taking these discounts, a lot of times when they look at companies to see if they're going bankrupt, one of the things they look at is if they are missing their discounts. Because it is so much better, you know, you're better off to go to the bank and get a loan, even if it's at 10%, to take this discount than to lose it. Because that's basically a 36% incentive for you to pay it off. Okay. Let's take a break. We'll pull up the next one. Basic inventory. So let's go ahead and take a break, and we'll be back at Oh, this is a 7. Oops.
What time did you say to come back?
Oh, 7.
Okay, thank you.
You're welcome. Yeah, I'm sorry, I was muted. Let's go ahead and get started on problem one, inventory. And just in general, inventory can be kind of a pain, just because there's stuff coming in all the time, and there's stuff going out all the time. You know, you think about something like a Walmart, a store. You know, they have truckloads of stuff coming in every day, and they have truckloads of stuff going out every day. So it's constantly in motion. So it can be a little bit tricky to figure out inventory, what you sold, what you still have, and all that kind of stuff, because you're actually looking at kind of two different ends of it. Now, yeah, let's say we're selling something. Here's a toy that I'm selling. Let's say that I bought it for $3, and I'm going to sell it for $5. Right. So I bought it for $3. So it would be in my inventory at $3. I sell to somebody, they give me $5. Now notice that I didn't make $5 on that sale, because I paid $3 for it. So, you know, this is going to go, this is gone. It's out of the place now. And now I have $5, you know, they gave me, but this is gone. So the cost of this is what we call the cost of goods sold. What did it cost? Cost $3. It's an asset that I had that now is gone. So if I paid $3 for it, I sold it for $5. I made a profit of $2. That's kind of the whole idea behind inventory. The selling price minus the cost of it, whatever you paid for it, and then whatever's left over is what you get to put in your pocket from it. So that's kind of the idea behind it. Okay. So let's take an income statement. We had sales. Sales are what we sold. We'll say 50,000. Let me move that over. Because in here, I'm going to do this inventory stuff. Okay. So inventory, we have beginning inventory of 5,000. And we purchased another 30,000 of inventory. So if we add those two together, okay, so these are the goods that were available. This is the most inventory we could have sold. The most we could have sold was 35,000. That's all the inventory we had. We had this beginning inventory. We shipped in another 30,000. So we had a total inventory that we could have sold of 35,000. Now, we didn't sell all of it. And the reason we know we didn't sell all of it is because we have this ending inventory. You know, the ending inventory is basically what was not sold. So we want to find out how much we sold. How much of this inventory did we sell? We know that the 33,000 was not sold. So how much of it was sold?
$32,000.
Yep. So what we're going to do is subtract this out, and actually this will be a negative here. So this is what was sold. This is what was gone, and it's gone. It's never coming back. Let's make it, I guess, maybe purple. Make it purple. So 32,000 of it is gone. So here's what we get. We got $50,000 of sales. 32,000 of our inventory is gone. There's still 3,000 left. We subtracted it out just to get that, how much was sold. And so our gross margin or profit, how much we make on this thing would be the difference between those two. And again, this inventory, the reason why it's in there as a negative is it's going out, it's leaving the place. And this is called gross margin. It's sometimes called gross profit, either one. They're the same thing. And so this is kind of the classical inventory thing you have, is that what, when you buy the inventory, you take the total amount that you bought plus what you had before, give you the total available. And then you look and see what you didn't sell, and the rest of it must have been sold. Okay. Now, we have a problem with when prices change. If prices are always the same, it doesn't really matter which method you use. But if the prices change, costs change anyways, it makes it more difficult. So here you look at page 2. And we know that we sold 90 units, we sold for $40 each. Now, the selling price is really easy. Whatever you sold it for, that's it. Right? I mean, whatever they handed you back when they, when they bought the 90 units, that's what you get. So sales are pretty easy. Now, when it comes to inventory, if you look at this, you say, okay, wait a minute. If we're going to try to see how much profit we made, it depends on which ones we sold. Because they aren't the same price. So if the cost of them changes, that's a problem. And we have to come up with a method of figuring out which ones we're going to assume were the ones that were sold. So the first one that we're going to look at is called first in, first out, also called FIFO. You'll see this called FIFO more often than spelled out like that. So FIFO is what you'll see it called, first in, first out. What this really means is first in, first sold. So first in, first out means first in, first sold. So we're going to assume that these first ones we had in here are the first ones that are sold. And that's probably the way it usually happens anyways. Okay, so let's take a look at this. See, look at this problem here. Okay, sales. We sold 90 units. We had a selling price of $40 each. So this is how much cash came in. And again, sales are pretty easy because you know what you sold it for. Okay, so we sold 90 of them, $40 each. Now we got to find the cost. We have to find the cost for these 90 units. Okay, so first in, the beginning inventory, these are the first ones that are in. I think of a clever way to do this. So the first one's in with this beginning inventory of 80 units. So we're gonna go to this first layer first. Now we need 90. We only got 80 in this layer. But we're gonna take those 80. They have a cost of 22. Whatever 80 times 22 is. Did something wrong.
You have L22 selected instead of K22. Or
Oh,
13, sorry.
yeah, that would make a difference. Okay, so this will be the total over here. Now, messed up my thing here. So we found 80 of them. We still need the cost for how many? Because, you know, we sold 90. We got the cost of 80. So these are gone, right? These are no longer there. I'm just gonna draw a line through these somewhere. Maybe not. Yeah. Oh, you can't already see it. Okay. So these are gone. So these are gone and they're not coming back. So we got to go to the next ones in. But how many units do we need to find the cost for still?
Ten.
Okay, so we still need to find the cost for 10 of these. Now we go down here. Notice there's 60 in that layer of inventory. But we don't need 60, we only need 10 of these. So what we're going to do is, instead of taking all 60, we're only going to take the 10 that we need, and we don't need any more after that. Okay, so this will be our total for our cost of goods sold. We sold 90, we got the cost for 90. We assume that the first one's in where the first one sold, and that's probably the way most of the time it works. But yeah, so we sold the first ones. Ran out of the first ones, had to go to the second ones we bought. And you know, there could be like 50 layers of inventory in here, but we only have 2, which is fine. And so our cost of goods sold is that. 210. Okay, so Let's get a little darker. So coming down here, what do we have? We have our sales. We have our cost of goods sold. And again, these are gone, they're not coming back. Oops, yeah, that's. And so this will give us our gross margin or gross profit. I thought the book used gross margin, could be wrong. Okay, so this is how much they made on these. So what this means is, you know, they bought them for. They bought them for $20,010. They sold them for $3,600. So how much did they make on it? Well, they made $1,590. Okay, calculate the ending inventory. Now, I'm going to come back up here. I'm going to split these up a little bit. You'll notice that this first one, there's how many are left. Read out a little more. Sold 80. How many are left? Coming down here, we sold what? 10. So how many are left in the layer? 50. So these are what were not sold. So that's gonna be our ending inventory. The ending inventory is what was not sold. We had what, 50 units. Cost was $25 each. Okay, did it right this time. All right, so this would be our ending inventory. In other words, what was not sold. So we sold $2,010 of them. So for $3,600, we made the difference there is $1,590. And oh, don't do that. And the ending inventory, what was not sold. Well, we're the 50. Okay. Let's go to this next method. This is the wacky method. Problem 3. Last in, first out. This is different than the one we just did. Instead of the first ones in, you assume that the last ones in were sold first. Now, we got to talk about this one a little bit more in depth. First in, first out is usually the way the inventory goes. What comes in first is sold first, right? And it makes sense that, for instance, beginning inventory. If you sold something on January 1st, it was probably coming from the beginning inventory, right? Someone walked in the store, bought it, it was already in the inventory at that point. Last in, first out says that the last ones in were the first ones you sold. So the one that you haven't even gotten in the store yet. And you say, well, what a stupid method. Well, it's actually a theoretical best income estimate. The more recent price, if you talk to economists, the more recent price is the more relevant price. You know, that's the value of that inventory today. You get the latest price. That is your best estimate of income, is using that latest price. Now, inventory doesn't flow that way. You know, on January 1st, you don't jump in the time machine, go to January 29th, you know, grab a gallon of milk, come back to January 1st and sell it to a customer. But that ending price for the milk, that's the best estimate of the true value of whatever it is you're selling. So this is a theoretical method. It doesn't actually flow this way. You know, it'd be hard to, you have to really play tricks to come up with something that flowed that way. But this is a theoretical that it gives you the best income. Now, to show you that this is pretty controversial, the United States is the only country on the planet that uses it. And there's sometimes that you are pretty much told you have to use it for taxes. So it's kind of a strange thing that the rest of the world does not recognize last in, first out. You're prohibited from using it because they say nothing flows that way. That's not reality. In the United States, we sometimes use it because it generally gives you the best estimate of what the true income is for the place. So in case you're wondering, like, why would you ever use that? It's theoretically the best numbers to use for calculating your income. But again, nothing really flows this way. But that's the reasoning behind it. Okay, it's pretty much the same though as the other one. It says which ones do you pick first? Okay. This is exactly the same as before. So we have our sales. Same thing. You can just copy and paste from the previous page if you want. And so the sales are not impacted by this at all. Whatever you sold it for, you know what that number is. It's not disputed, shall we say. We need the cost for the same 90 units. Now, here's where it gets a little funny. Oops. We're going to take the last ones in first. Okay, so. We sold all those, they're gone, and they're not coming back. We still need the cost for. What, 30? Do you guys see where I'm getting it from? It comes from here. If we need the cost for 90, we found the cost of 60 of them, then we still need to find more costs. You know, there's only 60 in that layer. So then we still need to find the cost for another 30. And we're gonna go to this first layer. And actually, we don't need all 80 of those. I'm gonna put it in here, but really don't need the cost of 80 of those. We only need the cost of 30 of them. Okay, so this is our cost of goods sold. The sales, what color did I use on the green? Cost of goods sold, these things are gone, they're left, they're not coming back. And so this was our gross profit or gross margin. Oh, I did this wrong. Shoot. Yeah, make those blue then. So hard to get the colors correct here. Okay, so coming down here, our ending inventory. We have 50 units times $22 equals some number 1100. Yep. And again, this method is not the actual flow of inventory, but is theoretically, this is more accurate. Mouse is going crazy here. Spelling not good. I've left out into something. I left out a O. So economists will tell us that this is a better number. Now, it did not. That was not the flow of inventory, but this $25 ending balance, ending cost, is theoretically the best estimate of what the income is for this place. So that's why we used up that first. Now, notice these two are exactly the same problem. They have exactly the same information. But it changes your profit depending on which one you do. You know, your profit over for FIFO was $15.90. Your profit under LIFO was $1,440. So actually change your profit. And again, LIFO is very popular in the United States, although it's starting to wane a little bit because international standards don't allow for it, but it's still used. And again, it theoretically gives the best income. It's not an inaccurate depiction of what the actual inventory sales are. Okay, any question on that thing? It's kind of funny though, you know, I mean, you can imagine this is just for selling, you know, onesie twosie. You start talking about things like making cars and that, we have stuff coming in from all over. So you have thousands of items, you know, and how they go in and the cost of those, how those, are you taking the first ones, the last ones, and all that kind of stuff. It sounds funny, but one of the hardest things you can ask is, you know, what does this cost? And people think that it should be easy. Like, well, what does it actually cost? You know, what does it actually cost? How much do we actually make on this? It depends. It depends on how you come up with those costs. It's not as easy as you might think. Okay. This one doesn't look like very much fun. This must be like a problem. Okay, FIFO versus LIFO ratio analysis. The idea behind this, I think there is one of this in the homework. The idea is that you're going to come up with different ratios because even though they're identical, because they're doing different, using different numbers based on the method that they're using, that you come up with different ratios. Again, you know, ratios are not that difficult. They're just kind of like making a cake. They say, go get this and you go get that, put it in. Okay, net income. $29. Might as well get the net income on this one too. 19 divided by sales. Right, these in your head almost. You might put those into a percentage. I'm not sure if the book has those in a percentage or not, to be honest with you. They should say whether it's a percentage or not. Okay, inventory turnover. Okay, we look at the numbers, cost of goods sold. And X uses FIFO, Z uses LIFO, and you kind of see that the more expensive ones, the later ones are sold for company Z. Those are the LIFO ones. These are the FIFO ones. Okay. No, I did that wrong. Don't do that. Hold on. Oops. Okay, so they're selling their inventory every 172 days for company X and a whopping difference of half of the many days, 67 days for company Y. And again, it's just because of the different methods they're using. It's not because of here, wait a minute. And again, you want to sell your inventory quicker. So the lower the days, the higher you want this to be higher. And you want this to be lower. And they will be like that. The highest one here will be the lowest one here. So okay, current ratio. I'm going to copy this down here just to get it closer. Yeah, closer than that. Okay. So current assets. Current liabilities. Current assets. Current liabilities. The current ratio, that's how many of your, how much of your assets, your current assets could cover your liabilities. In other words, what you have, you're going to get in the next year versus what you're going to pay out in the next year. And you want this to be high. In this case, it's lower for company with life. Question on that? Okay, let's go through the last one. Yay. Okay, you might say, well, why do we, we're doing inventory. What's that got to do with accounts payable? Well, a lot of them, they go hand in hand, basically. You order something, they send it to you, and usually there's those payment terms. There's a lag in when you pay it, so you have an accounts payable on the books. So that's why accounts payable is put in with inventory. You go, wait, inventory is an asset, and payables are a liability. Why are we looking at those together? You're looking at those together because they kind of go together. The transaction usually is you buy the inventory, and then you have this liability that you have to pay off for that inventory. So they kind of go together. That's why we're looking at accounts payable in the same chapter. Okay, and again, we just grab the numbers they want us to grab and put it in there. Accounts payable turnover. Get our cost of goods sold. Get our accounts payable. Same thing over here. Get our cost of goods sold. And get our accounts payable. Okay, so we have that. Wait a minute, where is it? I lost it. There we go. And any of the turnovers, if you want to get the days, you just plug it in down here. Take 365 divided by the turnover. All right, so it looks like we're paying off our liabilities in 90 days. That's a really long time. My guess is you're getting a few phone calls on those. But anyway, 90 days is paying off, and year two, you're paying it off in 85 days. Probably they're yelling at us to pay quicker. Well, this is Coca-Cola, so maybe they are stretching it out. One of the kind of ugly things that a lot of times happens is when you have a large company and small companies, is you get this. They take a long time to pay the small companies if they're suppliers, because very well could be 90% of their business goes to Coke, so they pretty much take whatever terms they can get. Is Coca-Cola Enterprise taking longer to pay its accounts payable to its suppliers? No. Wait a minute. No. They're paying them faster. They're paying them in 85 days instead of 91. The ratios in the company indicate that the company's credit risk is increasing. No, it's going down. They're paying it off quicker. This still is a long time to wait. You have to get paid, but it is getting better. And you can see the accounts payable are going down also. So. Okay. So that's it for that. Inventory is not, it's not terribly difficult, it's just tedious. There's so many parts, there's so many moving parts to it, but it's just tedious. It's not really, I don't think it's like theoretically difficult. Any questions? No, you guys are sleeping, aren't you? I should be quiet, talking hushed tones. Anyway, if you guys have any questions, if you ever want to do any of the homework, go ahead and shoot me an email. And I'll be happy to, we set up some time. I'm free most time. The only times I'm not free is obviously Tuesday night. We have class here, and Thursday I have a class from 6 to 8. So those 2 nights are the only 2 nights that I can't, but most of the other times I can. And I like doing it at night, but I'll do them anytime. If you can't do it at night, that's not a deal breaker at all. I can do it other time. And I will record whatever we cover. I'll record it and put it up so that you can look at it. There won't be any extra credit to it, but it'll be there if you want to go over it. Any questions? Okay. Well, I will talk to you guys later. Bye.
Thank you.
Thank you.
Thanks. The wrong thing.
I just had one question, Mr. Taylor. For the exam, how many tries does it allow you to get? 1 or?
No, I think I told you guys it was 5. I increased it.
Oh, for the exam too? Okay.
Yeah. I think I increased it to 10.
Oh, good. Oh, good.
Sometimes people get, there are things that just happen. Sometimes the computer goofs up or something.
Yes.
Anyway, yeah, you get, I think it's 10 now. I think it's
10, okay, wonderful, that's perfect. Okay, thank you so much. Have a good one.
you too.
Bye-bye.